What are they saying?
Well, they're worried about markets getting stretched. And Sherry, this is touching a nerve with markets, with investors, because this is what a lot of people are worried about. How long can stocks continue to move higher without getting overly stretched? Lael Brainerd is the board governor who is head of the Financial Stability Committee. As you just said, they put this report out twice a year. She wrote her own separate statement. And here's how she summed up the problem. The combination of stretched valuations with very high levels of corporate indebtedness bear watching because of the potential to amplify the effects of a repricing event. In other words, if stocks start selling off, corporate bonds are under pressure perhaps, then you could have something that snowballs. I'm putting words in her mouth, but there's obviously concern here. The Fed's report also said prices are vulnerable to significant declines if risk appetite falls. And let's move on to another very important point, because this report, pages and pages, went out of its way to talk about Archegos Capital. They said the losses due to Archegos Capital call for more granular, high-frequency disclosures. Let's look at that particular statement. The Archegos event illustrates the limited visibility into hedge fund exposures and serves as a reminder that available measures of hedge fund leverage may not be capturing important risks. Well, when you see big banks around the world losing billions of dollars, you can see why the Fed is getting a little bit nervous, even though they said all along it was not a systemic risk. Finally, people, you've got the Fed zero rates, you've got the billions and billions of bond purchases. This is the kind of thing people have been talking about for a long time now. Is that the kind of thing that is fueling that reach for yield? Is that one of the things helping stocks continue to move to these lofty levels? Jay Powell was talking about this last week at the press conference after the Fed's policy meeting. He did say he sees risks from frothy stock prices, financial imbalances, but he sees them as manageable. Unlike Rob Kaplan, president of the Dallas Fed, who thinks the Fed's got to start talking about tapering now, pulling back on bond purchases because of the financial excesses that are out there. Most Fed officials don't agree with that, but I wonder how this financial stability warning might impact Fed thinking.
What could also impact their thinking, right, Kathleen, is economists predicting another big over-the-moon increase in U.S. payrolls. What could that potentially change?
Well, we shall see, but let's start with what we saw in jobless claims today. If you want just another sign of how well the recovery driven by vaccinations in the U.S. is going, reopenings, take a look at jobless claims. Weekly jobless claims had a big tumble. They were down quite a bit. You can see that is the blue line. They're down to about 500,000 now. Of course, at the peak, they were up around 15 million. So that is certainly progress. Continuing claims was they were up over 20 million. They have come down a long way as well. Now, in the report tomorrow, the unemployment rate is seen falling to 6% in March remember at the pandemic peak, that was up to about 15%. So a lot of progress. The thing is, though, one more chart to pull up, and that's the Fed. This is their favorite thing to talk about. Yes, we're making progress, but there's more than 8 million people unemployed still. That is the problem. You can see the peak. You can see the big decline in jobs. You can see a lot of progress made. 2 months in a row, this is going to be potentially of about 1 million new jobs created. The Fed wants to wait and see what happens next. They don't want to move on forecast. They want to be sure they're doing the right thing when they finally start that Fed taper.